The New South Wales Government has a plan to offer first home buyers the option of paying a large amount of stamp duty when they buy or an annual land tax of a much smaller amount. And this may well be rolled out into other states and territories if it turns out to be a successful policy. But what do you need to know before you choose your option? Welcome to Your First Home Buyer Guide, the podcast for first home buyers who want to get it right.
I'm Megan and that was Veronica. We're both buyer's agents and probably old enough to be your mums. But that's a good thing because between us we've got over 40 years experience and we are going to share with you bucket loads of stories about avoidable mistakes. Together we're going to make sure that you get unbiased and real information that you can rely on so you can get where you want to be without missing a step.
Now, we've got loads of great tips for you in this episode, and if you'd like more useful tools, head over to the website homebuyeracademy.com.au. There you'll find free checklists that you can download, a free mini course on how to price a property, and our Where to Buy workshop for only $39. Priceless stuff, really.
Bargain. But before we get into the interesting stuff in this week's episode, here's the boring bit, the disclaimer. You, of course, know that nothing in this podcast is to be taken as personal advice. We always recommend getting the advice of an expert in their field of expertise. Now, we've done our very best to ensure that the content is correct at the time of recording, but things change. So check with the relevant government authority or your advisors to get the most up-to-date information. Today we're talking about choosing between saving up another 5% or roughly on top of your deposit for stamp duty or committing to an annual land tax bill of a much smaller amount. What are the implications for each option?
But before we get into that, what's your special house this week, Megan? Looks like we're back to your house.
Yeah, regular listeners will remember in episode 92, I introduced you to my home, my renovation, which kicked off at the start of this month. Now, this is the start of week 3. Demolition is done and the house raise is well underway. If you haven't lived in Queensland or owned a timber house, that sounds like such a bizarre way to renovate a house. You're not adding another story on top. You're actually lifting the entire house and putting another level underneath. Now, so far, in one day, they have raised the house about 50 centimetres. They've moved the house forward 1.6 metres and to the right, 0.2 of a metre. Now, it was the most fascinating process to watch. I was just so enthralled yesterday. I couldn't leave the site. I kept taking videos and photos and I got so sunburnt because I wasn't expecting to be there. But it was really, really interesting to do. Now, she is currently in her final resting place and will go up another roughly 900. So it'll end up about 3 metres at the highest point. It is a fascinating process.
So they jack it up further, nearly a metre.
Yeah.
And the classic is, I'm looking at you, Megan, you do look very sunburnt, so I can see the worst.
So red. And after, I really get onto my kids in the morning, put your sun cream on.
And naughty mum, she wasn't out there with a hat on either, obviously.
I was for the last hour, but that was way too late by then.
Too late. Damage was done. I have to say, yes, being a New South Welsh person as I am, I do still find it quite bizarre that you can, shuffle your house along on the site, which is just incredible. And also that doesn't then results in all these cracks. And I imagine that's what the builders have to go through later on and pin back any weatherboards that are falling off and cracks in the plaster and all the rest of it. So it should be very interesting. I can't wait to see the next stage.
The
I
progress.
Guess. Yeah. Now, what are we talking about today? In September 2022, the New South Wales government announced that first home buyers purchasing properties for up to $1.5 million would be able to choose to pay an annual property tax instead of stamp duty. And, it's an interesting one, this, because despite the fact that a number of governments...
Attractive.
Sorry?
Sounds attractive.
It does. And we'll go into this.
Delve into it.
Yeah, it's not straightforward at all. And there's a lot of variables. And And also there's some calculators, there's stamp duty calculators and all the rest of it we'll include in the show notes, but even that's not straightforward. So we really want to put the spotlight on some little anomalies here, unusual aspects you need to be aware of. Because, despite the fact that a number of governments have been looking at ways to replace stamp duty with land tax, and the ACT have already done this, right? So, and stamp duty is seen as an inefficient tax for a lot of reasons, right? And the New South Wales government previously had a different plan about getting rid of stamp duty and replacing it with land tax. It was a bit more of an ambitious plan, but they've had to water it down to now only apply to first home buyers. And they're saying that it will only be payable by first home buyers, a new tax, who choose it, and will not apply to subsequent purchases of a property. But I say watch this space, because I think governments have made their
almost
intentions.
like it's a trial.
Well, that's it. And it's also they've got to break it down, this sort of challenging legislation, into palatable chunks. And also the New South Wales government, we're looking at an election next March, so they don't want to do anything too scary. They want to be seen to be helping first home buyers. But I really do think watch this space. I think that it's quite clear, if you do pay any attention to what governments are talking about in this area, there is a definite desire to replace stamp duty with land tax, a broad-based land tax.
And look, they've got a lot of lessons to learn from the Queensland government's failed attempt to make mass changes to land tax, which has since been repealed actually hasn't been repealed, it's been shelved. That may come back out again, but it was ill thought out, illogical and poorly planned. So there's a lot of state governments that are doing some investigative work, and hopefully will prepare themselves better than the Queensland government did. And perhaps this is New South Wales's little lesson that they've learnt from that is, don't roll out mass changes without seeing if it's actually going to work first.
Well, that's it. And certainly that was unpopular. If we just sort of digress a little bit, the Queensland government was planning to really hike up the land tax bill for investors. And so it's funny, because I think some governments do think that investors are like an easy target.
Like
it's
a cash cow.
Yeah. Whereas first home buyers are seen as, the poor first home buyers, they need a hand. Let's pitch it as helping first home buyers. It's like a Trojan horse. I think
tugs at the heartstrings, doesn't it?
Yeah.
And we actually did an episode on that land tax, and then it was shelved, so we didn't release that. So if you're wondering what we're talking about, it has actually been shelved and hopefully won't come back again.
Yeah, you never got to listen to it, listeners, because it was shelved before we
really
actually published
really
it.
Good episode, no.
We do try to keep this
Thank
stuff current.
goodness it went.
Yeah. Yes, we were happy to scrap that episode that we'd recorded for you. All right, so let's kick off with what's in this New South Wales thing, and bearing in mind that even if you're not looking at buying in New South Wales, these are principles to be aware of, because they may well end up in your state or territory. In New South Wales, there are existing stamp duty concessions for first home buyers, and they're available for purchases up to $800,000, right? And these will continue. That won't change. And what that means is that up to a purchase price of $650,000, you're not paying any stamp duty as a first home buyer. And then it's sort of phased in up to $800,000 where you pay the full whack.
Yep. There's a lot of qualifications, sort of criteria too, Veronica. It's, you and your spouse, you can't have owned previously. You can't have owned or co-owned residential property in Australia. You must not have received an exemption or concession under the First Home Buyers Assistance Scheme. So lots to think about here and explore. And you must move into the new home within 12 months after buying the property and live there for at least 6 continuous months.
And that last one is actually very important, because as we'll get to, what I discovered is that the land tax for investors is a lot more than the land tax for owner-occupiers. And we'll go into that. I guess I'll explain that in a minute. Now, actually.
Is that under the new regime, or is that existing? Because in Queensland, your principal place of residence is exempt from land tax. So is that
Correct.
the case in New South Wales as well?
Yes, it currently is. Yes. So what will happen though, what does happen, if you are an investor and you own a property in New South Wales that has a land value, and let's just pull that apart a bit. The property's value that land tax is calculated on isn't the purchase price, isn't what the property is worth as a whole. It's based on the unimproved land value. So that if you've got imagine it's a block of land. It's however the valuer general values that block of land. If it's an apartment,
not even the market value, Veronica. It's
not
the
even
valuer
market.
general. So it's actually a government entity that places a value on that block of land, not what someone would pay for that block of land. So it's not the market value.
And so that valuer general's valuation, if you like, or the unimproved land value, that's what they base all the rates on. So your council rates and then obviously land tax are based on that valuation. So it's very different. You can spend $1 million on a purchase price, but the land value might be $400,000. So the land tax is based on the land value and stamp duty is based on the purchase price. And so when prices are rising rapidly, your stamp duty bill's going up accordingly, whereas land tax takes a lot longer actually to be revised and start increasing. So they'll assess it every year, and so it's a sort of a much slower, and it's assessed on a rolling 3 years value average or something like that. Yeah. So in terms of shocks to the actual land tax bill, you don't get as many shocks there, whereas with stamp duty you can get quite a big shock as prices rise. The thing too, that as an investor, if there's a threshold under which if the land value doesn't reach that threshold, you don't pay any land tax, right? And once it's over that threshold, you do pay land tax. So there could be some investors or rent investors that might not actually have to pay any land tax currently, even though they're investors. There's also apartments. There's a land component with apartments, but it's obviously a lot less than a house. So if you've got a block of land with 6 apartments on it, that's the land value will be divided by the lot owners of that apartment building. So if you've got a big apartment in there, your proportion of the land, your share of that land will be larger than, say, for a 1-bedroom apartment in the same block, but there's going to be a value attached to your portion of that land. So with some apartment owners might not currently, as an investor, need to pay land tax, and others might. And also if you own more than one property, you're going to go over the threshold in total, and so you'll be up for it. So it's a little bit complicated. So, and I think it's important to distinguish that stamp duty is calculated on the purchase price, land tax on the valuation of the unimproved land. But let's just look at what stamp duty currently is on, say, 3 different price points.
Okay.
So
let's have a look. I'll kick off this first one and you can go through the analysis. So what is the stamp duty currently on a $1.5 million purchase? And you've gone on to the state revenue calculator and put that information in. So this is directly from government sources. And that's $67,000 you would pay if you purchased a $1.5 million property as an owner.
Give or take a little tiny bit. I rounded it up.
Yeah.
Or down.
This is all owner-occupier rates. This is not investor rates. They are different. And what about $1 million? If you purchased a home for $1 million or an apartment, then your stamp duty would be $40,000, give or take. And then next one, we're going down a little bit, about $650,000. You wouldn't actually pay stamp duty if you were under $650,000 and $651. Yeah.
So the minute you click over 650,000, you start paying stamp duty. So if you
that you calculated that, didn't you?
$10. That's how much stamp duty you need to pay.
Click over. But I mean, oh gosh, I want to throw this in here, Veronica. We talk and talk and talk in the course about not letting these kinds of limits influence how you set your budget. So just because you click over $650,000 and have to pay some stamp duty does not mean you should not buy a better asset if it's $660,000.
Correct.
So we don't want these limits to define how you determine your price range, and that's a really, really important fundamental of making a good asset decision.
Now, you've got to remember, because the stamp duty is based on the purchase price and the land tax is based on the unimproved land value, it's not as simple as a calculation as saying, well, if I bought any property for $1 million, for instance, then my land tax is going to be X amount of years before it adds up to whatever the $40,000 is for my stamp duty bill, right?
Yeah.
Different properties will have a different equation, a different calculation because of their different land value. And that means that you do have to really go through an exercise to work out, well, what am I up for? And so I went through some examples, and then we're going to talk about some variables. Okay. So the first example is I looked at a property that sold for $660,000.
Mm-hmm.
And I actually looked at real properties because I have to punch in real addresses.
To find the land value that is associated with that property.
Exactly. At first,
that's
I started
not a
doing.
Guess. You can't guess it.
No, I started doing hypotheticals. Then I realized I need real examples. This was a real sale, sold for $660,000. If it was a first home buyer, that stamp duty that they would have had to pay would have been $2,073, right? That's as a first home buyer. Any other buyer would have had to pay the proper, 4.8% or whatever stamp duty is. And the property tax, so if you're a first home buyer now this is not going to be effective till next year anyway, but when it's effective, you would have the option to take the property tax, which on that property was calculated at $1,150 per year, or the stamp duty. Now, it's a no-brainer. That means that in less than 2 years of paying land tax, you could have paid your stamp duty.
Yep. And then you wouldn't have land tax after that time.
Yeah.
If you just pay the stamp duty, you wouldn't have an ongoing land tax if it's your principal place of residence.
Exactly. And we will get to that. So I thought, well, that's a no-brainer. So then I thought, well, what about at $700,000? What does that mean? And this is where it starts getting interesting, because $700,000 purchase price as a first home buyer, your stamp duty is $10,363. And the property tax is annual at currently, and I'll explain how this can change coming up, is $1,414. So it works out to be roughly, after 7 years of paying the property tax, you've paid about the same as your stamp duty, right? So in that circumstance, that really comes down to how long are you going to stay there for, and also you might think you're only going to stay there for 5 years, but what if you stay there for 10,
Well, things change and you nest down and it's great and the community's fabulous and the schools that your kids go to or might go to, or you meet somebody and you nested up and suddenly you're there for 10. That's adding up now.
Yeah. So there's a bit of a line ball one, something like that. Then you crank it up to $790,000. Now, remembering that once you get to $800,000, there's sort of no more stamp duty concessions, but you're still getting some tiny stamp duty concession at a purchase price of $790,000. So the transfer duty is another word for stamp duty on that is $29,017. So, and thinking as well, that's $29,017 that someone's had to save up on top of their deposit to buy this property. The property tax based on that land value is $1,522 per annum. So that works out to be roughly 19 years of land tax to equal the stamp duty. That's starting to look like a no-brainer.
There's a pretty good picture forming here.
A couple of caveats, which we will get to, just bearing in mind there's a couple of things you do need to be aware of. But yeah, it's starting to look pretty compelling, isn't it?
Yeah. And I think the main message is it's property specific. You almost need to make the decision on a property specific basis, because that land value component is going to be different for every single property that you look at.
True. And budget specific. I think that's important too, because for instance, my next example was a $950,000 purchase price, right? Now, the unimproved land value on that particular property was $383,000, whereas that $790,000 example, the purchase price that I just gave you, that unimproved land value was $374,000. So $9,000 difference in the unimproved land value, which means that the land tax, or the property tax, as they're calling it, but the land tax is very little difference, even though the purchase price is so big. So there's $160,000 difference in the purchase price.
And there's a whole episode that we need to go into about why land values are so different, one property versus another, but the price may be so vastly different. It has a lot to do with what actually sits on the land, how much you're paying for that versus how much you're paying for the land. But we digress. That is a whole nother, it's not proportion. You don't pay more for the land when you pay more overall for the purchase price.
Exactly right. So in this $950,000 purchase price example, that transfer duty or stamp duty would have been $37,840, right? So that's
on top of your deposit.
Yeah. And that's, the one before that, the example was 29,000. This is like nearly 38,000. There's nearly $9,000 difference in stamp duty. But the actual property tax, so the land tax on an annual basis, there's only $27 per annum difference. Like, so this is it. You got to get into the nitty-gritty here and understand property specific. So in this example, that's roughly 24 years of land tax. So you could live in that house for 10 years.
Yes.
You paid 15.
Well ahead.
Yeah, well ahead. You're looking about 10 grand ahead, if you live there for just for 10 years.
Now, I think, Veronica, we've also got to probably just throw in there that you would have to index for some potential increases in land tax over time, because land values generally do go up. There's no formula. It is based on market movements, but it isn't a market appraisal of the land. So you would have to apply and allow for some indexation of land value over time, which would increase your property tax over time.
Absolutely. I've got some examples coming up on that, because that's very, very true. And the other thing too, we're assuming that they're going to stay at the same rate of calculation. So currently the calculation is the land value, right? So the tax is calculated as $400 plus 0.3% of the unimproved land value plus $400. Right. That's how it's calculated.
Pretty simple, actually, because a lot of land tax is actually scaled. So the higher the amount of the land that you own, the more you actually pay as a percentage. So this one's actually a flat rate.
Yeah, and that could change. So if they start applying this to not just first home buyers, that might change. There might be a scaling come in. All this stuff is open to future change. And I think that's one of the big things. All the opponents of this are really sort of out there going, but what if it changes? How can you trust the government? And look, I'm sure it would never change greatly, but even adding a 0.5%, it's going to make a big difference. So you just got to be mindful that these things can change. And I've just calculated how many years of land tax, to pay the stamp duty.
Some pretty strong assumptions under there, and I think you've outlined those really well. I've
calculated a flat rate. So just bearing in mind, it wouldn't be quite that. Now, at the very upper end of this, because of course this option caps out at a purchase price of $1.5 million. So if you're competing for a property and you've got that much money as a first home buyer, and you find that, you want to have this option, you don't want to pay $1.5 million and $10,000 for something, because you won't be able to get this as an option. You will then have to stump up the land tax. And I did an example of a property that sold for $1.48 million, right? So 20 grand shy of the limit. And the stamp duty for that was $65,600, right? So you get your $67,000 at the $1.5 million mark. And the property tax on this particular property that I looked at was $2,392 per year. And if I just did the flat calculation, that's roughly 27 years of land tax. Now that's a bit of a no-brainer, isn't it? Like, even if you index,
does that
27
27 years, you would have to live in that home and pay tax on the assumption that the rate doesn't go up, which we're not suggesting that you make that assumption. But 27 years, and that's the average person turns over, I think the ABS figures are around 7 years or so.
Well, interestingly enough, our Treasurer in New South Wales, Matt Keane, has said that Treasury figures say that half of all owner-occupiers sell their home within 10.5 years.
Okay.
So, and most first home buyers likely to sell even sooner. So they've got a big pitch. They want first home buyers to take this option up.
Yeah.
And just a couple of quick things in terms of indexing and land values going up. If you remember back the $700,000 purchase price example, I just worked out that if land values were to rise by 3% per annum, after 10 years, the annual land tax bill on that property would go up from $1,414 per year. And after 10 years, that would be $1,762 per year. So, and obviously it'd be gradual. It wouldn't just be like in year one, it's $1,400, and year 10, it's $1,700. It would go up gradually, but that's on a 3% annual increase. If it went up by 5% per annum, after 10 years, the land tax bill would be $2,052 per annum. So, it can go up quite a lot, but I guess in that time you're potentially earning more money, all the rest of it. But, obviously that brings back that the amount of years it takes before the ledger is equaled, right? And this is something just to be very mindful of. You might even run your own calculations on this. So put in
strongly
a figure.
recommend you run your own calculations on this. And when you're analysing an individual property, run it by your accountant or someone who's really good with numbers.
Or they've got Excel, those little calculators on Excel. They'll be able to map it out for you and tell you, right, this is how many years you need to sell before to be ahead.
Yes.
Now,
and then put some contingency in there.
Yeah. And obviously, so it does actually make it very complicated, when you're trying to assess this. But I think the other thing that we need to talk about is the investor option, because the stamp duty option might become much more attractive to somebody, a first home buyer, who is planning to, live in it within 12 months for at least 6 months in order to qualify. And then they're going to move out and rent it. And so
what do you find with this one, Veronica?
Well, this is the thing, isn't it? So you do need to be very mindful. So I calculated which one did I look at? I looked at the more expensive property in this example, which was the $1.48 million property. So let's just say I'm going to buy this property. I'm going to live in it for 6 months within the first 12 months, and then I'm going to rent it out. So in my first year of owning that property, my land tax bill might be $2,392. And then in my second year, assuming the land value hasn't gone up, my land tax bill is going to go up to $8,804.
Once it becomes an investment property.
And because the threshold changes, right? And the percentage changes. So so what it is, it's still calculated the same land value, but instead of being $400 plus 0.3% of land value, now it's $1,500 plus 1.1% of land value. And that's the tax under this option for investors.
Okay, so Veronica, is that different to the current rates?
Yes. So this is very interesting. With land tax, if you're an investor, there's a threshold, as I mentioned before, and it actually goes up every year. But if we worked it out for the 2022 financial year, the land tax threshold currently is $822,000. So that's the unimproved land value. And what it's saying is that if you buy a property that's got an unimproved land value, anything up to $822,000, then you don't have to pay land tax.
As an investor.
But the minute you buy another property or that value goes up over that threshold, then you start paying tax, right?
Yep.
So this particular example that I've used here, which is the purchase price of $1.48 million, if you are a first home buyer is going to live in it, and you're going to live in it always, right? Then you choose the option to pay land tax, and your annual bill is going to be, nearly $2,400, say, as opposed to a stamp duty bill when you purchase property of around about $66,000. So that's a bit of a no-brainer. You go, I'd rather spend $2,400 per annum than pay $66,000 up front, right? Because I'm going to
be out of there in about 20 years or so or less. It probably the equation might add up.
But if you become an investor, if you move overseas and you decide to rent that property out, if you
work interstate,
go interstate, if you meet someone else, or even if you get divorced and you take the property in your divorce settlement, but you can't afford to live there, so you might move out and rent somewhere else and rent it out, any of those sort of scenarios, you're going to be up for land tax, which will increase substantially. And so in that example, that your $2,400 per year, if you're owner-occupier, will go up to $8,800 per year if you become an investor. And that's assuming current rates, the current valuation. So if that goes up, it's going to go up. Now, if you were an investor, not a first home buyer, or if you're even a first home buyer investor who just says, I'm not going to live in the place for 6 months, right? As in,
get the advantage of the first home buyer.
I'm just going to buy it and then invest it out from day one. I'm not going to worry about trying to get first home buyer grants. This is a classic example about where getting grants can shoot you in the foot. If you're a total pure investor, this property with an unimproved land value of $664,000 falls underneath the threshold for land tax. You wouldn't have to pay a cent. So you would
Because
be,
it's quite a high threshold in New South Wales.
it is a high threshold.
Yeah.
So if you're going to be an investor, otherwise your calculation, so if you live there for your 6 months or whatever, I worked out at something like 8 years of land tax, and that's not indexed, right? So it will be less than that, which means if you're buying for an investment, I would want you to be holding that property for a lot longer than that. Right? You don't buy and sell as investors, right? You might buy and sell as a first home buyer,
as a stepping stone kind of strategy. Yep.
As an investor, you're not buying it. You don't want to begin buying and selling. There's lots of costs of buying and selling, and they erode your gains as an investor. And this is a massive one. So I would say, based on these calculations, if you are a first home buyer intending at any point to make this an investment, you've got to really get in there and understand the implications.
Yes. Get some good advice around this, because it looks good at a really high level. Like initially we're looking at that going, wow, 27 years.
No brainer.
That's a no brainer. But you start looking at the trade-off or the opportunity cost of, well, under the old regime, how does it work? If I do it under the new regime, what's the difference? There's a lot more to look at here than just making some really simple calculations and going, yeah, I'm going to opt for the land tax option because I haven't got to save the extra $65,000, $66,000. It's just not that simple. It is far more complex, and there are so many assumptions that you need to think about. But there's also a lot of future gazing that you have to really think about. What if this happens? What if that happens? What if that happens? And it's like putting a will together. You have to think about all the worst case scenarios that could possibly go wrong. It's a horrible process to go through. What if, one person dies and the other one doesn't? All of these sorts of scenarios, you really have to have a good hard think about these things, much more than, I guess, the simplicity, as much as you and I do not like stamp duty, but the simplicity of stamp duty is it is what it is.
Well, that's exactly right.
There's no choices.
Let's just run through some of those variables just to sort of cement them, I guess. The first thing is remembering the distinction that stamp duty is calculated on the purchase price, whereas land tax is on the unimproved land value as per the valuer general, which means that you could be spending, like that example there, or one of those examples, $160,000 more on a purchase price, and the land value is very similar to a lower price property, or vice versa. These things can move around, so just be very aware of that. Also, that apartments have a smaller land component than houses. So and this is where it's the government
is sort of divided up between the contributions that are made under the body corporate or strata plan.
Yeah. And so obviously the government calculator that you use to work this stuff out is you put in the address in. So it will tell you based on, their their land value. So you're not making a guesstimate on that, which is good, but be very aware of that.
A lot of limitations. Yeah.
And obviously how long you're going to live in the property is going to be, as Megan was saying, you've got to crystal ball gaze and you've got to try to work out
all
your
sorts
future.
Of scenarios.
It makes a big difference, though. Makes a really big difference.
Nobody goes into a property purchase thinking, what do we do if we get divorced? But you've kind of got to.
Or how are we going to outgrow this property? How long are we really going to be here for? The price you pay, obviously closer to that sort of $650,000, the bottom end of it is less benefit than there is at the higher price. So that makes a big difference. And then the land values can vary, as I mentioned before. So just really make sure you get into that.
Let's do just a quick dive into that, because I think it's important. It could be somewhat confusing for some people to say, well, why when a property goes up by $600,000 between one purchase price and another purchase price, why hasn't the land gone up $600,000? Like, shouldn't it be proportionate? And we really just touched on it earlier, but let's dig into it just for a minute, because I think it's important, because there's a big difference between what you pay for the land and there's a differentiation between what you pay for the land component, and what you pay for the thing that sits on it, which is the improvements like the house, the pool, the apartment, the age of it, all of those sorts of things. So the more you could have a piece of land that is under the value general's eyes, the same value as a place next door. But what sits on top of it might be, you know, a nice, simple 3-bedroom, 1-bathroom, low set brick on concrete slab with a single garage. You're not paying a lot for the house that sits on that land in that case, versus perhaps an architecturally designed 3-level, 5-bedroom, you know, smart wired, you know, all the things that add up to differentiating between your little 3-bedroom and your quite significant architectural masterpiece that's sitting next door. But the land can actually have the same value. And that's why there can be a difference, no difference really in the land value, but a lot of difference in the purchase price because it's what sits on top of it.
Yeah, absolutely. So then you could say, looking at those variables, that somebody buying the unrenovated shack might be better off to think about paying stamp duty in some cases than somebody buying the architectural, you know, masterpiece next door. So
absolutely. And I think that's a key point, isn't it? Because it can make a really big difference. And if you're going to knock down the track, knock that house down, or, you know, we look at from an investment point of view, we actually assess the land content by looking at the unimproved land value as a percentage of the purchase price. And for investors who are looking at a long-term capital growth perspective, they want the highest percentage of land that they possibly can, because they're not focused on rent. That's not so important. That's what the house gives, or the piece, the thing that's on top of the land. But it's the land that they focus on from a capital growth perspective. But often when you're looking at a home, you're looking at, well, how do I live in this? What features does it have? What sizes are the bedrooms? What is the layout? You know, that more functional livability aspect of what actually sits on top of the land, as opposed to I reckon a lot of people wouldn't even know what their land is worth from a value general or a site value perspective.
Yeah.
Do you find that sometimes?
Absolutely. And I forget myself, to be quite honest. I mean, I know where I can get it, and I check every now and then, but, you know, it doesn't sort of matter.
Until the rates come in and they go, yeah, we've re-averaged your 3 years to this. And I think there's an important thing that is really, you know, something you only learn after a lot of years experience, and that is that you can contest land valuations. And if someone has contested a land valuation and been successful and actually got their land valuation reduced, you may get a terribly difficult surprise if the next time the valuation comes in, it's back up to a reasonably assessed range, and it's vastly different to what you purchased and did your figures on. So lots and lots and lots of factors to take into account when you're deciding whether it's stamp duty or land tax might be the best option.
Yeah, because you're not really in control of that ongoing. You know, I hate it when I get a land tax bill, you know, for my investment properties, and I sit there and I go through it and curse and all the rest of it. But anyway, yes, every year you're going to get that. Every year you're going to look at your value going up, not necessarily as an advantage. You know, like you'd be thinking, oh bugger, that's got up. That means my bill goes up
because it costs you more. Whereas if you paid your stamp duty, your principal place of residence, you have no land tax. You want your value of your land to be going up. So you actually have really, you know, converging desires for what you want your land to do.
It's a bit bizarre, isn't it? Now, when will this happen? Well, the government's really intending that legislation will be introduced to Parliament before the end of this year, and eligible first home buyers who sign a contract to purchase on or after the 16th of January 2023 will be eligible to opt into the property tax and not be required to pay stamp duty in order to complete their transaction. So that's 16th January next year. And eligible.
And I imagine you can't change your mind, right? Once you've made your choice, that's it.
It is exactly. And so basically, they're saying that even after they've done the legislation, and if anyone buys a property after it's or between the time when it's legislated and the 15th of January, so before the actual official date, they will also be eligible to opt into it. Although it just this is what the website says, these purchasers will be required to pay any applicable stamp duty within the usual required periods, and from 16th of January 2023 will be able to apply for and receive a refund for that duty. So, God, what a bloody ridiculous setup.
This is going to be expensive to administer, isn't it?
I know. But anyway, so once it's passed through Parliament, that is, they're obviously very confident it is going to be passed through Parliament. They're talking as if it's fait accompli. That's why we're doing this episode. So you can get your head around it before it becomes law. But, you know, that's, you know, they're there's certainly an intent, thinking that it's going to go through.
Strong intent there, isn't there? Yeah.
And obviously, once it does, you can get into the property market a lot quicker if you don't need to save the stamp duty. But not everyone, as I hope we've shown today, will be better off by taking the land tax option.
As always, consult your professional, the expert in their field, which in this case is most likely going to be an accountant or accountant type person. In this episode, we've covered a very small part of our 10-step online course for first-time buyers. If you would like to learn more about the process and how to buy without making a mistake, then head over to our website, www.homebuyeracademy.com.au. Don't forget to subscribe to the podcast so you won't miss an episode. And if you like what you've heard today, please give us an iTunes review. 5 stars would be wonderful. It will help others find us as well.
Thank you for joining us. We hope you found this really useful. And if you have, please share the love with others who you know are in the same boat. We'll be back next week with some more priceless stuff.